Marc Chandler with Brown Brothers Harriman. Just too much to talk about. What is the backstory on foreign exchange trading desks right now? Is everyone on vacation? Is everybody asleep? Or is it actually busy?
I think it's busy, but I think it is the summer, so it is a bit quieter. But I think a lot of people are waiting for Bernanke to speak on Friday for some fresh clues on what the Federal Reserve is going to do about the weakening of the economy.
Clues? I'm playing this down. I mean, everybody's looking for a redux of last year. Do you expect a big announcement? Do you expect some major direction?
Well, I think a lot of people, especially at the banks, are hoping for another round of asset purchases. But I think they will be disappointed that the Federal Reserve will not announce QE3. I think that Bernanke's outlined a list of options that he could do, but he'll probably do some modest ones, limiting to words and word cues rather than an actual delivery of a policy.
Let's go to dreaded first chart here. Home on a range bound, and this is a dollar. Marc Chandler talking up the dollar a year ago, maybe more so. What a tight range we've been in. Is that unique to see DXY in such a tight range?
Well, you know, the DXY is primarily the euro and currencies that look like the euro. So it's not a clean read of the U.S. trade, the dollar relative to the rest of the world. But I think it does indicate what a narrow trading range we've been in. And part of that, I think, market and participants really lack conviction. It's really like the ugly contest, which has gotten uglier, and bad things about the U.S. as well as bad things about Europe. And it's like leaving us in this range. And of course, you still have the talk of China, talk of Middle East selling dollars on any kind of rally.
I mean, it's just so interesting. Let's look at the great distortion here. We have a range-bound dollar. Well, not the Swiss franc. This is trade-weighted Swiss franc. I love this chart. It shows this distortion. There's how tight the trading of that indices was from 97 to 08, and then the explosion here. I mean, this is the knock-on effects of this financial crisis, isn't it?
Yeah, I think in some ways the weakness of the dollar, the weakness of the uncertainty in the global economy gets filtered out and gets expressed by people buying the Swiss franc and also buying the Japanese yen. And so I think that the Swiss franc is really the more extreme version of the safe haven flows.
Let's bring back this chart again. I want to explain the lines. Those are the regression and the standard deviations of that very tight trend to the left and center of the chart. And we're out 1, 2, 3, I can't count that high. I think like 10 standard deviations. I mean, it's absolutely unique. We covered this earlier this week. What is a central bank to do when they face this distortion to their public?
Yes, it's a hard thing for the Swiss to deal with. My suggestion is really there's a very strong relationship between the Swiss franc and the stock market. And that is, we use the stock market as a risk metric. And if people become more afraid of the world economy, they buy Swiss francs. So if I were to advise a Swiss National Bank, I wouldn't be thinking about pegging the currency of the euro or shadowing it or something like that, but maybe doing what the Bank of Japan has done. And the Bank of Japan goes out and buys ETFs on Japanese stocks.
It's remarkable. I want to switch to an essay you wrote here. We talk to you about foreign exchange. We'll do a little bit of that in our next block. You really looked at the 30s in our labor economy in the 30s. What did you summarize here of what we need to do now?
Well, I think that's really bringing us back to the Jackson Hole. Is Bernanke going to say, what can he really say? And I really wonder out loud, in a way, is monetary policy, have we done everything we can do with monetary policy? Right. Nearly a $3 trillion balance sheet. They just spent $600 billion buying treasuries. And it didn't really do that much good for the economy, for employment, for even the stock market net. And so I wonder if maybe Bernanke is better served by saying, We've done as much as we can for monetary policy. Now it's really got to be a fiscal policy issue. But of course, there's not a lot of political will in Washington for a fiscal stimulus package. But what about a jobs program like the WPA under the New Deal, where they build the infrastructure?
That would be a bombshell at Jackson Hole if he got out in front of the president's speech in September, supported the president and supported something away from economics.
Yes, I think that something like that. You know, there's all this talk about having an infrastructure bank, and this would fit very well into that infrastructure type bank, local government, hiring local people. The WPA did all kinds of wonderful things.
They just repaved Madison Avenue. It's gorgeous. Let's bring up that chart if we can right now. This is Guadalcanal. We're going to work on that chart. There it is. I love this chart. It's a Louise Yamada chart in honor of her being with us yesterday. Mark, this is 1929 to 1942, and that circle I call the Guadalcanal Rally, which is the beginning of that huge post-World War rally. We say that with great respect for our heroes at Guadalcanal. But the crash, to depression to Guadalcanal? And the answer is that was a long nothing. That's the risk now, isn't it?
Right. I think that's the danger. I think we need to resist that, because think about what happened during that long period, not just in the U.S., but also in Europe, of course. The weakness of the economy, the economic challenges had a political response, and not a very friendly political response, I might add. And so we need to avoid that. We need to, even we've got people like Rubini now talking about the end of capitalism.
I want to go back. Let's go back to this chart we just brought up in the 1930s. You want an infrastructure bank. You're not a policy wonk from Washington. You're like us, you pay tax. Why should our tax dollars go for an infrastructure bank if the private market can do infrastructure?
You know, I don't know if the private sector can really do the infrastructure. I think what we're talking about is how is the economy going to get lifted? And what's the biggest concern for Americans? I don't buy the stuff that we hear that the biggest concern is really the deficit. When I talk to people, my family in the Midwest, more concerned about jobs and job insecurity.
Jobs.
And so my thinking is then that for the Federal Reserve to buy another $500 billion worth of treasuries, $600 billion worth of treasuries, is not going to create a single job. What will create jobs is infrastructure jobs. Those are jobs that are employed by Americans, and it just generates that income and a multiplier effect.
Right. Byron Wien on Bloomberg Surveillance today. Let's look at the note here from Mr. Wien. This is his August note. He goes right to where Chandler is. One of the biggest mistakes the president made was in setting priorities incorrectly by putting health care before job creation. I mean, essentially you're saying the same thing Byron is.
Yeah, except I'm not so sure. I mean, I don't know the order of sequence of events. I think that a year ago, or 6 months ago, it looked like the economy was recovering.
Right.
And then we got those revisions. And so I think that the data set that we have to deal with, that policymakers have, that investors have, keeps shifting on us, and we have no place solid to put our footing.
I want to switch gears here. We need a solid footing, and part of that is an emerging market that's growing. Here's a Brazilian real. Look at this chart, folks. I brought this up before, but never on the show. Here it is, and at the top there is the single dumbest decision Tom Keene ever made in the markets. That's the Lula election, essentially. And I said, you got to be kidding me. And look at the Brazilian strength from there. Remarkable how the real's gone from 4, well under 2 here. Does that continue? Does this emerging markets continue? And is that enough to help pull America and Europe out of their slow GDP?
Well, it's probably not even, the emerging markets, even including China, are probably not big enough to lift the U.S. and Europe. However, the emerging market story is a fundamental story that's with us. It's sort of part of the story for our generation, really, is that the rise of the emerging markets. In this Brazil case, it's fascinating because as Lula was getting elected, people like George Soros and some of his advisors told Brazilians, you vote for Lula, you vote to bankrupt your country. And these last 20 years or so, there hasn't been a period in time better for Brazil. Now, the Brazilians are it's too much of a good thing now for them. The currency is getting a bit too strong for them. You're already seeing this on their trade balance is hurting. From the intervention, it's blowing out their budget deficit as well. And so they're trying to resist this pressure on the currency.
Go back to that chart, please. I'm sorry, I'm messing up the control room here, but let's go back to chart number 3, if we could, Rexets. And you can see it there, a less visible intervention. How do they or South Korea intervene and not make the headlines of the Swiss National Bank or the Japanese?
Well, partly they have regular interventions, almost on a daily basis.
Yeah, you and I see those on the Bloomberg.
Yes. They could also change for example, they had been tightening policy, raising interest rates. Now maybe they've done tightening policy. And through verbal things, as well as what Brazilians have done is tax. They use taxes to make it a disincentive. So if you can get, say, 10 extra percentage points by investing in Brazil, they'll tax it 6% now. Should
Switzerland do that?
I think it's something that they're considering. I think that it's likely not to work as well for them because it's not so much this hot money coming to their asset markets. Because the Swiss have generally had a fiscal balance, there's not a lot of Swiss bonds out there for foreigners to buy.
What is the myth? I'm playing off your book about the dollar. What is the myth right now about European banks?
I think that the general myth is that we know what's going on. That is that despite the stress tests, despite the BIS reports, banks do not know what the other banks have as far as their debt, and that's why they're charging more to lend to each other.
Right, here's a chart here. This is a surprising chart, folks. Beneath the radar of DSK and, of course, what's going on in Tripoli, Greece and Portugal widen out. Greece had a particularly ugly day today. The white line is Greece to Germany, and the yellow line is Portugal to Germany to spreads. And just very quietly, these two have gotten ugly in the last few days.
Yes, I think that partly there's a battle over back in July 21st when the EU had this new agreement for Greek 2.0 bailout package. The Finlands had wanted to get some collateral. If they're going to loan Greece more money, they want collateral. And so the EU basically told them, work this out by yourselves.
Right.
And once the Finns announced a deal, or the Greeks announced a deal, then everybody else wants a piece of the action.
Yeah.
Nobody wants the Finns to be the first ones in the queue. Why shouldn't it be Austria?
Is this interesting or what? It's
Yes,
amazing.
Yes, I think that what they need is like Alexander Hamilton.
That's what we need. It's a break exclusive. Marc Chandler says we need Alexander Hamilton.